For retirees and near retirees, here is the simplest way to understand taxes. The IRS taxes your income like a cake. If you know which layer it eats first, you'll see how two people with the same income can end up with very different tax bills. In a minute, I'll show you how $70,000 can mean thousands in tax for one retiree and only a few hundred for another. The cake has two layers. The bottom layer, which is ordinary income, traditional IRA and 401k withdrawals, wages, interest, non-qualified dividends. This bottom layer gets eaten first. It gets eaten faster and it's typically taxed the hardest. The top layer, that's long-term capital gains and qualified dividends. This layer only gets taxed after the bottom layer. In many cases, it can be taxed at 0%. Key rule, the IRS always eats the bottom of the cake first. One note before we get into the two examples, there's also a new temporary deduction for filers 65 and older worth up to $6,000 that I am leaving out here to keep the math simple. So if we include it, it would make these numbers move even further in their favor. Let's compare two single retirees in the same year with the same income. Person A draws $70,000 from a traditional IRA. That's all ordinary income. After a roughly $18,500 deduction for a single filer over 65, about $51,500 remains as taxable cake. Since it's all the bottom layer of the cake, it moves through the lower brackets. So the result is thousands of dollars in federal tax. Person B also has $70,000 of total income. Layered differently, they draw $20,000 from an IRA and $50,000 from long-term capital gains in a brokerage account. Same deduction. That deduction wipes out nearly all of the bottom layer. About $1,500 of ordinary income remains, and that $1,500 gets taxed in the 10% bracket. About $150 of tax. Now, the IRS looks at the top layer. With the base almost cleared, most of the $50,000 of long-term gains can sit inside the 0% long-term capital gains bracket for a single filer. Added up, person A pays thousands. Person B pays a few hundred. Same income, different cake. Here's the insight that changes retirement planning. Taxes don't only depend on how much you earn, they hinge on what kind of income fills the bottom of your cake. Keep the base thin, and more of the top can land in the 0% gains bracket. A quick story, a couple in their early 60s wanted to understand why friends with similar spending paid less tax. Their cash flow came mostly from IRA withdrawals and interest. Their friends spent from a brokerage account with long-term gains and qualified dividends, while the standard deduction cleared their small base of ordinary income. We changed the withdrawal order, realized gains up to the 0% threshold, and scheduled measured Roth conversions in the gap years before Social Security and required minimum distributions. The goal was steady cash flow with a lower lifetime tax bill. Here is a simple order of operations you can review once a year. Step 1, map your cake. List ordinary income at the base. IRA withdrawals, wages, pensions, interest, non-qualified dividends, short-term gains. List preferential income on top, long-term capital gains, and qualified dividends. Step 2, apply deductions to clear the base. Your standard or itemized deduction reduces ordinary income first. Check your filing status and current year thresholds. Step 3, harvest gains on purpose. If the base is low after deductions, realize long-term gains up to the 0% bracket. lock in basis, keep flexibility, and maintain room for future planning. Step 4, fill lower ordinary brackets with intention. In early retirement years, consider measured Roth conversions at known rates while your base stays low. Step 5, avoid the cliffs. Be aware of Social Security benefit taxation, Medicare IRMA surcharges tied to income, and the 3.8% net investment tax at higher levels. Aim for clarity, not surprises. A few grounding notes for you. Thresholds change by filing status and by year. State taxes may apply. Examples here are for illustration, and the sequence is the part that matters most. So when you hear same income, remember the cake. The bottom layer, ordinary income, gets taxed first and the hardest. The top layer, long-term gains and qualified dividends, can receive 0% treatment when the base is thin. So shape the cake, not only the total. If you're retired or within a few years of retirement and want to see how this applies to your plan, there's a link below to connect with me directly. We'll map your cake, your deductions, and your brackets so you can see in black and white whether small changes could lower your lifetime tax bill while keeping your plan steady.